Good day, everyone. I'm Siendrajit Kaur Bamra, moderator for today's Valuation Month session 30, organized by Valuation Standard Board of ICI. We are delighted to welcome you all to an enriching journey through valuation. And it's my pleasure to be a moderator in Valuation Manthan session 30 on recent changes in 11 UA, organized by Valuation Standards Boards of ICI. In a short while, we will start this webinar. I would like to brief you all about the board. The Valuation Standards Board of ICI is responsible for developing and maintaining valuation standards in India. Its primary objectives include aligning these standards with global practices, engaging with stakeholders, providing guidance, and promoting the adoption of Indian valuation standards in various sectors. Through Valuation Manthan sessions, we are empowering participants with cutting edge knowledge and insight to excel in the dynamic world of valuation, fostering expertise and innovation. So, without further ado, let's just start our today's session by welcoming the Honorable Chairman of the Board, C. Hansraj Chukji, for opening remarks. Welcome, sir.
Thank you, Inderjit. Thank you. My co-chairperson in the board, CA Preeti Savla. She hails from the western part of the country, from Mumbai, and naturally she is a great contributor in the different activities at the ICI, more particularly on the Valuation Standard Board. She is instrumental, or the originator rather. She conceived the idea of bringing out every Sunday for 2 hours a manthan for the better understanding about the profession or the of the valuation to the membership at large, not within the country but beyond the boundaries also. With those kind of the thought or the fertile brain she carries for the, and naturally she is always been keen to give the best to the profession in the different, whether it is the SRSB she is heading with, or the other level wherever she has been contributing for the growth of this profession. Welcome you, Preeti Ben, to this 30th series. The speaker of the day, Vijay Kumar Puri ji, he has a very great experience and will bring out about the recent changes in the 11 UA in this Valuation Manthan series 30th. And the moderator of the day with us in the Ji office team here, Dimple and the Rahul ji, and the participants in one and all. I welcome each one of you to this series of the Valuation Manthan. Today we are moving through the 30th in numbers and in continuance, no break except maybe one, because of the same day some valuation programs were going on. So we clubbed together. So that is the spirit. Yes, we have to be in continuance. The naturally it's a consistency which matters in the system. Once we start understanding any subject, so if it is goes with the consistent, that has a major impacts. And today the subject which our speaker will be speaking about is of the high relevance in the system of the valuation for the many purposes in the regulatory system of the country, in the requirement under the rules and the laws of the countries. In unregulated atmosphere, we have a many session which has already gone, divided in two aspects. One is under the law required through a mechanism of the some rules framed by the different laws. Another one is the by way of the need of the commerce and the economics and the business. So those aspects both are being covered through this series. And I'm really very grateful and thankful to the participants, which has always been growing and running into the thousands now. So with this initial remarks, I welcome each one of you. I welcome my co-chairperson. I welcome the speakers, Vijayji and the Inderjeet and the office team also. So now I'll request Preeti Savla, the co-chairperson, to share her word of wisdom and definitely going forward how this valuation series or the valuation board can be taken forward. Preeti, now it is over to you. Dash is with you now. Over to you.
Very, very respected Chairman of Valuation Standard Board, C. Hansraj Chutji, under whose guidance our board is working very well, and various other committees. The FRRB is also doing great job, and they have the target of more than 100 reviews, and most of the target is also achieved. Various training programs are also being done in across country, so that the proper justice and justification and proper review can happen in the quality manner. Very dynamic speaker, CA Vijay Kumar Puri, will go through us the section 11 UE, and this 2 hour session will be very very quality learning session. I can see Inderjit Bamra, who is coordinating. So, friends, whatever all your questions are there, you can put in the chat box, and those will be taken care by the speaker at the end of the session. I welcome all of you to this 30th series. Since last 30 Sundays, we are all uh, sharing the valuable knowledge with all the speaker from all the knowledgeable speakers, and you all are the beneficiaries. So I also welcome each one of you, and hope this will be a very knowledge imparting sessions, and the sessions will also be uploaded on the our website. So anytime in future also you can go through the same. With these words, I welcome all of you and wish you a happy learning on this Sunday. Now the season of festivity is starting. The Navratri, the Dashera, the Sharad Purnima, and now we are moving ahead for welcoming the Diwali. So wish you happy Diwali in advance. And KYM, I can say, if you are all of you must have done the KYM and renewed your membership. However, 31st October is the last date. If you are not done so far, I request all of you to please do it as early as possible. And any support, if you face any challenges, any issues, any support required, we are always there. We have our ICI call Sahayata, which is a national call center. You can store the number 9975 So Monday to Saturday, morning 9 to evening 9, you can call and resolve your issues. Till even if you have any facing any challenges, feel free to connect any of us, so that your issues are sorted out. With these words, I welcome all of you, and over to Inderjit. Thank you.
Thank you, Vice Chairman ma'am and Chairman sir, for inaugurating this session and directing us in the right direction. So, like CA Preeti Salva ma'am said, I would like to have your attention. We have a question domain to source your questions and doubts. So, we will answer them in 15 minutes before by the end. So, as our dignitaries briefed about the topic, now we will be hearing from our expert speaker on this subject. So, it's my privilege to introduce CA Vijay Kumar, a distinguished member of the Institute of Chartered Accountants of India and a partner at VPRP and Company LLP, with a background that includes invaluable experience at E&Y and KPMG in international tax and regulatory practice. He has emerged as a seasoned expert in his field. Vijay Kumar's proficiency extends to business and asset valuation, particularly in the context of merger and acquisitions. He is a published author and a recognized speaker, with his work featured in prestigious professional journals. His commitment to knowledge sharing and involvement in professional forums is truly commendable. So, please join me in welcoming CA Vijay Kumar, an exemplary professional with a multi-faced passion for learning and sharing knowledge. So, welcome, sir.
That was that was quite an introduction, I would say. Thank you so much. And respected Chairperson Sir Hansraj ji, and Vice Chairperson Ma'am Preeti Savla Ma'am, and thanks for the amazing introduction, Inderjit ji. And today it's a lovely Sunday morning, and I warmly welcome all the participants. I'm based out of Mumbai, so it's a pretty breezy weather today, and even on this Sunday morning, you have joined and in order to learn something. So I warmly welcome everyone. I'll just share my screen while we are going to. Do have a PPT and everything is there, but I prefer to uh, you know use the act as much as possible. The preference is to go into the bare rules. The last month it was 25th of September when the changes were notified, and today it's the 29th of October, and still these changes are being talked about. Various interpretations are arising, various questions are arising. So while the changes are will get technical in the end, but you know we'll try to analyze everything looking at the bare act as well as the bare notification which has come. So moving on, so how we are going to structure this session today is our agenda will be divided into. We'll go from the basics of angel tax, which is the core here, to the technicalities, which is under the charging sections 56 to 7B, and then we will also look at the changes in Rule 11 UA and a few other amendments. After that, we'll also look at the issues which still remain, or which are arising, which are practically arising in the amendment. While we'll try to discuss them while looking at the amendments, but we'll also consolidate and discuss them in the end. Then we'll also look at the what are the impact on startups, considering angel tax is very well known, mostly in the context of startups. And after that, we'll also spend some time looking at the professional opportunities which are arising for chartered accountants and valuers out of this amendment. We'll try to keep the last 10 to 15 minutes for questions, and in case the questions are not answered, you can feel free to connect offline as well. So I'm always there for that. So, without any further ado, let's start from the conceptual part of it. So, what is angel tax, which is the entire hue and cry? We see a lot of in the past month at least, almost every 2 or 3 days there is some article on angel tax, the changes. You find it in Economic Times or Mint, and it's being talked about because of a very important change which had come in the Finance Act. We'll get to that. But where does this concept come from, angel tax? So conceptually, when a company receives money for issuing shares, it is not taxable, considering it is a capital receipt. And as per the rule, unless specifically taxed, a capital receipt is not taxable under income tax law. So similarly, when a company receives money for share subscription, it is not taxable. That is the general rule. However, this was being misused for money laundering. So what would happen is, if especially in case of unlisted companies, because listed companies are very well governed by SEBI and stock exchanges, but unlisted companies, what would happen is the investor would invest at a very high premium, and what would the company would receive the money, and using various techniques and structures, they could hide the source of the money. So that was being misused for money laundering. And the only reason was that if a company is worth, say, a share is worth 20 rupees, and someone is paying 100 rupees for that, and that is also not taxable. So that was a big loophole in the law. So what happened is, in Finance Act 2012, section 56 to 7B was introduced, wherein it was held that if an unlisted company is issuing shares at a premium, significant premium over its actual fair market value, the entire difference will be taxable in the hands of the company. So again, this was an anti-avoidance rule, which had been brought in to curb the prevalent practices of money laundering which were going on. But it had side effect or rather unintended consequence is because now in the 21st century, we also see a lot of startups. Now, the concept of startups is that they raise capital not necessarily on things which are existing. They raise capital not on valuations which are based on numbers today. They raise money based on valuations of which may happen in the future. So a lot of these startups which are in a very early stage, they are not necessarily, their balance sheet doesn't reflect their potential or the capability. So in the early stage, they approach angel investors, which is the basis for angel tax, the term. And they approach angel investors and they uh, pitch them their idea, and they ask the angel investors to invest in the company. Now, of course, when they are pitching the idea, they are not going to say that our company is worth the face value of the shares. They are obviously going to show the potential of earning income for the investors in the future, and based on that, they will use other various approaches and valuation methods to arrive at a higher value. So suppose the face value of the company is of the startup is say rupees 10, but based on the future projections and the viability of the idea, the investor and as well as the startup agree to a valuation of say 50 rupees per share. So that entire difference between the face value and the assuming the face value same as the fair market value as on date, the difference above the fair market value will get taxed in the hands of the startup. Now again, this was obviously not the intention of introducing section 5627B, and due to this unintended consequence, there was a lot of hue and cry back in 2012 as well, as to how this will happen. But the government had brought in a few exceptions. We are going to see all those exceptions in the ensuing slides. And the government had brought in a lot of exceptions. The government had brought in a lot of relaxations and notifications in order to ensure that at least genuine startups, they don't suffer because of this anti-avoidance law of section 5627B. So yes, so considering that, so colloquially this was known as angel tax. Now earlier, uh, I'll tell about the change in Finance Act 2023. So in this budget, what was earlier, the angel tax used to be applicable only when the investor was a resident. The investor was an Indian resident. However, in case of an investor who is a non-resident, that was not covered from 2012 till 2023. But in the budget, which is the Finance Act 2023, the law was amended to bring in non-resident investors as well. Now we very well know that a lot of startups, they raise money directly from foreign investors, and because of this, there was again a hue and cry after the budget was announced as to that angel tax will now get applicable for non-resident investors as well. And good concern or justifiable concern was also expressed that this, if the rules are not framed in the right way, even the foreign funding may dry up, which is very bad for the entire startup ecosystem, which is flourishing in India. And we can see in the past 1 or 2 years, the entire world economy has been in a recessionary phase. However, India has been relatively less affected by the funding winter, and a lot of it is due to the immense potential that India has, and the immense potential that startups have. And bringing a law in that time will had the potential, or rather has the potential, to adversely affect the foreign direct investment in India. So this is the reason why angel tax rules have been notified in the last month, and we'll get into. But first, let's get into the legal side of things. What is exactly the structure of section 5627B? So while I have it all in PPT, so I'll like to discuss it based on the exact law itself. So So yeah, so this is section 56. Section 56 under income from other sources. Let's go to section 56 to 7B. This section was introduced in Finance Act 2012. So where this section, as I said, it says where a company which is not being a company in which public are substantially interested. This term has been defined under section 2, but more or less it means an unlisted company. So where an unlisted company receives in any previous year from any person being a resident. Now you can see there's a footnote for here being a resident. This has been excluded by Finance Act 2023 with effect from 1st April 2024, which is assessment year 2024-25 and the previous year 23-24. So this has been excluded from the section. So this effectively means that resident as well as non-resident gets covered in this provision. So when an unlisted company receives any consideration for issue of shares that exceeds the face value of the shares, so suppose the face value say 10 rupees, the aggregate consideration received for such shares as exceeds the fair market value of the shares. So the trigger point is that the consideration is above the face value of the shares, and the taxability is the difference as exceeding the fair market value of the shares. So this is the basic rule. Now again, there was a lot of UN cry as to why is this happening. When it was introduced back in 2012, it was introduced for the first time. So there was a lot of uncertainty. So there were certain exceptions which have been provided in the section itself. So firstly is that this clause shall not apply where the consideration is issued by a venture capital undertaking, from a venture capital company, venture capital fund, or a specified fund. Now these are defined in the section itself. So if you see, yeah. So a venture capital company is basically the same as 1023FB, which means a venture capital which has been registered with the Securities and Exchange Board of India. So the intention of excluding, a venture capital funds or venture capital companies is that they are very well by SEBI. And since SEBI is regulating them, their chances of doing money laundering is is lesser, and so it's not it won't make sense for a startup to bear the brunt of that. So a venture capital is covered, and specified fund is also covered, which has been again defined as a category 1 or category 2 AIF, alternative investment fund, which is regulated by SEBI again. And recently, even the fund in IFSC, which is the Gift City, has been brought in the exemption. So they are not. So the provision, or rather the angel tax provisions, do not apply when money is raised from these funds. And also, the central government has given a power to notify as to any persons who are notified by the government in this behalf. So again, this is another this is fine. So there has already been while angel tax has been brought in, there were already exceptions for venture capital funds and even for notified entities. Now we'll come to what all entities are notified as and when we discuss them. But this is the overall structure of section 56 to 7B. Now, as we know, the taxability is on the excess over the fair market value of the shares. So a question will arise that how do you calculate the fair market value of the shares? Now, for that also there's a definition here. One is the fair market value shall be the value in A or 1 or 2, whichever is higher. So yes, as may be determined in accordance with the method as may be prescribed. Now, since it's written prescribed, it automatically takes you to Rule 11 UA, or as may be substantiated to the satisfaction of the officer. However, if you see, we have to take the higher of these two. Either higher of those would be the fair market value. So obviously, anyone would prefer, the as per the Rule 11 UA to be the actual value. And we'll now what we'll do is we'll go to Rule 11 UA. Just a second. Yeah, so this is Rule 11 UA, which is for, now I'll first show how the rule itself looks like, how the structure of the rule is. Now Rule 11 UA is divided in, as earlier the old Rule 11 UA had two sub rules, Rule 11 UA sub rule 1 and Rule 11 UA sub rule 2. Now for Rule 11, if you read Rule 11 UA sub rule 1, it says for the purposes of section 56 of the Act. So sub rule 1 covers entire section 56, which includes section 56 to 7b, which we just discussed, and also includes section 56 to 10, is popularly called as gift tax. And so for the purpose of section 56, so everything ought to get covered here under section 56 of the Act. However, sub rule 2, now this is the amended rule which has been hosted on the Income Tax Department. I'll show you the earlier rule. Yeah. So this is the earlier rule which was existing prior to 25th of September 2023. Prior to it, it would say, notwithstanding anything contained in sub rule 1. So this sub rule 2 overrides sub rule 1. It says that the FMV of unquoted equity shares for the purpose of section 56 to 7b. So it clearly says it applies only to FMV of unquoted equity shares. Now, if you see section 56 to 7b, it applies for any consideration for issue of shares. It does not distinguish between equity shares or preference shares. It says 56 to 7b applies for equity as well as preference shares. So Rule 11 UA sub rule 2 applies only for unquoted equity shares. Or that means if we are talking about preference shares, we have to look at Rule 11 UA sub rule 1, because the exception has been created only for unquoted equity shares, and that too only for section 56 to 7b. Now again, the earlier rule had only two methods which were allowed. So remember, this was only for residents when the considered investors were residents. So there only two methods were allowed. We'll get into it in detail, but basically the first one was the book value method, or the net NAV method, whatever you can call it. And the second was the FMV as determined by merchant banker as per the DCF method, which is the discounted free cash flow method, very popular in valuations all across, in practically most of valuations are done using the DCF method. Earlier, before we, I'll give a side note as well. I think by 2017, till 2017, a merchant banker and a practicing chartered accountant both were allowed to issue the report. But now it was, few years back, around 2017, it was removed, and only merchant banker was allowed to issue the report as per under DCF method. So this was the old sub rule. Now we'll look at the new sub rule, which has been notified as per in the notification dated 25th September 2023. Before we get into this, let us see sub rule 1. How does sub rule 1 look like? As you will remember, it is sub rule 1 will apply for your preference shares. An exception has been created in this new notification, but sub rule 1 will apply for anything other than unquoted equity shares earlier. So sub rule 1, if you see, is divided into three clauses. First is for valuation of jewelry, other is for valuation of archaeological collections, and third is for valuation of shares and securities. Again, this covers 56 to 10, even 50 CA valuations come in here. So in clause C, we get valuation of shares and securities. Now for valuation of equity shares, it is covered in subclause B for unquoted equity shares. For quoted shares and securities, it is determined in another manner, which we'll not get into right now because there has been no amendment in this. And C, this was the one. So since equity shares are covered in subclause B, the remaining preference shares, especially for the purpose of section 56(2)(7)(b), which is our angel tax, the preference shares would be covered under here in this C clause, which says that the FMV of unquoted shares and securities other than equity shares, which are not listed in any recognized stock exchange, shall be estimated to be the price it would fetch if sold in the open market on the valuation day. Now, these terms are defined in Rule 11U, but basically what it was saying is what would be its arm's length price, or what is the price at which it would be sold in the open market. And the assessee may obtain a report from the merchant banker or an accountant in respect of such valuation, accountant being a practicing chartered accountant. So in this, the option was given to the taxpayer or the assessee to obtain the report from either the merchant banker or the practicing scheme. So for preference shares under section 56(2)(7)(b), the option would be there. Now again, there was a lot of controversy on this word may. Since the language is that the assessee may obtain a report. So this was never a compulsion. So a view was arising that it is not compulsory to obtain a report. But excuse me. So for to justify what would be the price if it is sold in the open market, the practical way to do it is to obtain a report from either the merchant banker or the practicing chartered accountant. Excuse me. So this was the case for preference shares. Now, in the new sub-rule 2, which has been notified on the 25th of September 2023, what has happened is sub-rule 2 has now been divided into two clauses, A and B. So the clause A itself is only for unquoted equity shares. Earlier, if you remember, the sub-rule 2, there was no division. It was the entire sub-rule 2 was only for unquoted equity shares for 56(2)(7). But now, sub-rule 2 has been divided into two parts. Clause A and clause B. Clause A is for, as we saw, for only equity shares, unquoted equity shares. Clause B is for compulsorily convertible preference shares. So what has happened is, even compulsorily convertible preference shares, which earlier used to be in sub-rule 1, CC, which we just saw, open market, has now been brought into sub-rule 2. So this has obviously become this has also been a major change, considering this was not expected. Like the draft recommendations did not have CCPS here. But in the final notification which they have released, they have brought in CCPS as well under sub-rule 2. And we'll get into the details of the valuation. But the entire structure of 11(u)(8)(2) now includes unquoted equity shares as well as compulsorily convertible preference shares. This also means a corollary that optionally convertible preference shares will still continue to be under sub-rule 1, which the logic is also understandable. Compulsorily convertible preference shares are nothing but equity shares in the future. So they are a form of quasi-equity. So it makes sense to value them as equity shares, or are at par with equity shares at least. So this is the basic structure of section as well as the rule. We'll just solve this. So again, why were the amendments made? Now, as we discussed, the Finance Act 2023 brought in a big change, where now even non-resident investors were being covered under section 56(2)(7)(b. And the angel tax provisions would apply for them. Now, if you look at the earlier Rule 11 UA, Sub Rule 2, which was for unquoted equity shares, there would be just two methods. One is use the book value or the NAV method, or you get a valuation from a merchant banker under the DCF approach. So there were obviously a lot of points to discuss that, when foreign investors come in, they may not be using DCF only necessarily, or they may not be using the book value approach. They may be using other methods. Now, to discuss or to expand the scope for Rule 11 UA and to rationalize it as well, this DCF nowadays, every month, I would say, there is a new valuation method which we read about in the newspaper. There are valuations being carried out under new methods and new ways. So to expand the scope of how the startup ecosystem has already evolved, Rule 11 UA was needed to amend it. Again, yes, the stakeholders had a concern. Various representations went out to the Ministry of Finance as to 11 UA. So how it happened is it was applicable from 1st of April 2023. So in a very proactive way, I'd say in a very good time, the 26th May 2023, EBDT had issued a notification for the draft Rule 11 UA, and they had invited public comments on that, and that had to be submitted by, say, around 8th or 9th of June, and post that, on 25th of September, they came out with the final notification. Now, a lot of recommendations had gone out, from the ICI, from various, industry bodies, from, professional bodies as well. Representations had gone out, and most of the recommendations were, ignored. But more or less, the rules were the notification, apart from the insertion of compulsorily convertible preference shares, the rule was exactly the same as how they had given in the draft notification in May 2023. So let us look at what are the now we are looking at unquoted equity shares only. So this is a bird's eye view of what the new technique or rather the new methods are under the new rule. So if you look at sub Rule 11 UA Sub Rule 2 Clause A, which is for unquoted equity shares, there have been now 5 methods. So the assessee has the option to adopt the valuation as per any of the 5 methods. However, this method under D, which has 5 new other sub methods, is applicable only for non-resident investors. So these new methods, if a startup is raising money from a resident investor, the startup does not have the option to go behind the 5 new methods which we are going to see. And we have listed it down here: comparable company method, probability weighted expected return method, option pricing models, milestone analysis method, replacement cost method. These are allowed to be used only when a non-resident investor is investing in the startup. So A and B is more or less the same. NAV method and DCF are exactly the same as were in the old rule. So what has effectively been inserted are these 3. One is benchmarking, or also called price matching nowadays in industry circles, and price matching, benchmarking, and we are going to look at all of these methods in detail. This is how the revamped Rule 11 UA 2A looks like. This we are going to get into each of the methods. The NAV method, while it looks like very simple, but it's a bit different, and there are a few adjustments which we have to take care of. This is the bird's eye view of NAV method. So assets minus liabilities. One is book value of all assets minus the book value of all liabilities, less a few things which we will get into. But the core concept is that we only have to look at the book value. If we look at Rule 11 US Sub Rule 1, where we are valuing unquoted equity shares for the purpose of say 56 to 10 or other 50 CA as well. If you look at Sub Rule 1, there there's a NAV method as well for them, but that is different only to the extent that it does not ask for book value in all things. It asks for book value of other assets, but for an immovable property, they ask you to take the stamp duty value. That is not the case here. In here, they are asking for the book value of all assets and less the book value of all liabilities. Now, how this is beneficial to the income tax department and not to us is again, we'll get into that in the later stage. So let's look at this is normally the NAV method. However, it has a few adjustments. One is when you take the book value, you have to reduce any amount of tax paid or TDS or TCS or advance tax, less the amount claimed as refund. And you also have to reduce any amount which is unamortized and which is deferred expenditure. Now, a very common question which comes in every time is, whether deferred tax assets and deferred tax liabilities are to be adjusted. The answer to that is no, preferably considering even our institute's FAQs say the same thing, that DTA and DTL do not have to be adjusted. As the book value of all liabilities. So book value of all liabilities less all insider liabilities, you can say. So what we have to get out is the net asset value. So we are effectively reducing the book value of all outsider liabilities. While these are very normal things, paid up capital in respect of equity shares, the payment of dividends or preference shares, reserves and surplus. Considering India has now come in, lot of times the adjustments are made through other equity. So they also have to be checked when we are reducing the amount from under this method. Then again, any amount for provision for tax, and to the extent it is excess over the tax payable. Then any amount representing provisions made for unasserted liabilities. Again, something like say your employee gratuity or not. That can also be covered here if it is unasserted. If it's ascertained, then we don't need to reduce it. And any amount representing contingent liabilities as well, that also has to be reduced. So this is more or less the book value method, and this is at the option of the assessee. In this, the assessee does not need to obtain any report from any merchant banker or a practicing CA. However, now practically we have seen that the companies do prefer to obtain a CA certificate or a registered valuer's report or even a merchant banker's report for this. Merchant banker's report are obviously more expensive, so companies mostly prefer to go for CA certificate or CA's report. So this was the NAV method or the book value method. Second option is the DCF method, which was already existing in the old rule, as well as it has been continued in the new sub rule as well. So under this discounted free cash flow method, very common terminology, it's very well known in valuation circles, and it's always talked about. It is under the income approach of valuation. Effectively, what it says is that the value of an asset or the value of the business is how much income it would earn to the investor in the future. And that would be the exact value. We are not talking about the company's revenue or the company's profits. We are just talking about the free cash flow. The free cash flow which would come to the investor is how the valuation is determined. So again, we are not going to detail of DCF because that will definitely require another 2-hour session. But the emphasis is on free cash flows. We are not looking at imaginary metrics. We are just looking at a tangible method where we are estimating how much cash flows the business will earn over the next 3, 5, 7 years, and we'll discount that to current value. So discounting can be done at any risk-adjusted rate, and the discounting is done because 100 rupees in my hand today is worth more than 100 rupees in my hand a year from now. So in that simple logic, a risk-adjusted discounting rate has to be used. And yes, in this method, a merchant banker's report is required, and only a merchant banker's report is required. Earlier, even practicing CAs are allowed to do this, but in 2017, that was also taken away. Now only a merchant banker's report will be allowed for a DCF method. Next up is benchmark. Now this is an entirely new concept of benchmarking. Now under clause C as well as clause E, subclause C and subclause E, the concept of benchmarking is there. One is for VC funds and AIFs, and the other is for notified entities. So since the concept is very similar, we'll take both of them together. Now this is applicable for residents as well. So this benefit has been brought in for resident when the investor is a resident. The benefit of a benchmarking can be taken then as well. So if you look at benchmarking for a venture capital, so as you would recollect, I'll just take you there. In the section itself, it states that fair market, the proviso states that this clause shall not apply where the consideration for issue of shares is received by a venture capital undertaking, which is the startup, from a venture capital company or a venture capital fund or a specified fund. So if a VC is giving money or rather investing in a startup, if a category 1 or category 2 AIF is investing in a startup, investing in an unlisted company, in that case, this entire provision of angel tax will not apply. So this was already existing and this continues to exist. Now what the new method allows is that now they allow the valuation which has been arrived at by the VC or the specified funds or the notified entities, they allow you to take it as a benchmark for raising money from other investors. So if a VC is investing in my company, an AIF is investing in my company at say 100 rupees per share, the government or rather the income tax department says that, okay, if the VC is investing in you at 100 rupees per share, the value must be around 100 only. That is fine. It's not, the chances of money laundering are very low. The chances of avoidance of tax are very low. So you can take that 100 rupees per share as a benchmark when you're raising money from other investors. And this is a sort of a relaxation provided. No report from any, merchant banker or any practicing chartered accountant is needed. And let's also just, before proceeding, let's look at what are the notified entities. So even the notified entities get covered here, which were notified as per notification 29 of 2023. Yeah, so this is the notification 25th of May 2023. In here, they have covered a lot of, mostly the Cat 1 FPIs or government organizations and, investors from 21 countries. Now, we'll just quickly look at who are the notified investors here, notified entities here. One is obviously government and government-related investors such as sovereign wealth funds, central banks, etc. And the government ownership has to be 75% or more. Then banks or entities involved in insurance business, which is regulated in their home country. And other is the people from 21 countries, from the 21 countries which are notified. Category 1 FPIs, which are from either of these countries, or endowment funds from these endowment funds, pension funds, and broad-based investment vehicles, and again a lot of this. But if you look at these 21 countries, none of the tax havens are covered here. Asian countries are also very less here. Obviously, you don't have China and Pakistan for obvious reasons. But even countries like Singapore or Hong Kong or even Netherlands basically which all are tax havens, and where the tax rates are lower, they are not covered here. So these are just 21 countries which they have specific, from which if a category 1 FPI comes in, any investment which is made under made in a startup or an unlisted company will be exempt from angel tax. So these are the countries on this. So these are the notified entities, and even the similar to VCs and AIFs, the benchmarking is allowed for the funds which have been raised from there when you are raising the funds from other investors. So yes, the valuation is used. Only there are two conditions which have to be fulfilled. The allotment is made to other investors 90 days before or after the receipt of consideration from the VC or these notified entities, VC, AIF or these notified entities. This is, so if today it's 29th of October, so if suppose today I am receiving the consideration from these notified entities or VC, I can use that valuation which has been used with the VC for any issue of shares which is 90 days prior or 90 days after today. And the allotment to other, second condition, the allotment to other investors does not exceed the amount which has been raised from the VC or the notified entities. Now this is a very clever insertion, because what can happen is you may raise just 1 lakh rupees from a VC or a notified entity at say 100 rupees a share, and then proceed to raise say 10 crores from other investors. So in that case, this benchmarking will not be applicable. The government is smart enough. They have said that if you are raising 1 lakh rupees at 100 rupees a share from a VC, then you can raise up to 1 lakh rupees only at 100 rupees a share. If you are raising more than 1 lakh later on from other entities, you cannot use this method. This benchmarking method will not be allowed to be used. So just to illustrate, so there is a startup or an unlisted company, X Private Limited, which raises 1 crore from a VC fund at 100 rupees a share on today, 29th of October 2023. In this transaction, the angel tax provisions do not apply at all, because this transaction itself is specifically exempted from the section itself. So, and assuming that on 29th October itself, the consideration has been received. So, as per this new rule, between 31st of July 23, which is 90 days prior, and 27th of January 2024, if I am raising, if X Private Limited is raising money from other investors, they can raise at rupees 100 or below. Obviously, if you raise at above 100 rupees, then the difference will become taxable under angel tax. But any amount at rupees 100 or below. Now, when this rule had come out, a very practical or rather very logical issue had come out as to so we have raised money from VC, and just because of our post money valuation after VC round itself, we have got a lot of attention and lot of respect in the market. Our multiples have increased. So how can, if a VC is giving me at 100 rupees per share, my value has already become, after the VC has given me, it has become 110 or 115. So how is this method fair? So in that case, the answer is obviously a very logical question, and the answer is also very simple. Don't use the benchmarking approach. Go for a use the NAV, which mostly doesn't work, or go for DCF. Or if you have foreign investors, then use the 5 methods which we are going to discuss. So again, just to remind, these are optional. So all these 5 sub clauses are optional. It's at the choice of the assessor. So if it raises money at a price above 100 rupees, the difference will be taxable if clause C or clause E is exercised. So this was the benchmarking technique. Now we'll move on to the 5 new methods. Again, these are only for non-resident investors. If you're raising money from resident investors, you still do not have the option. Again, when we had made the representations back in May and June, during that time also we had written that these 5 new methods should not be applicable only for non-resident investors, but to make them applicable for resident investors too, because even resident investors use all the methods we are going to look at. So however, that was not considered in the final notification. So for now, these 5 new methods are applicable only for non-resident investors. And yes, a merchant banker's report is needed. Only a merchant banker is allowed to issue the report here. So let's look at these methods in brief. This is the comparable company multiple method. Now again, this is a very common method, very commonly used everywhere. This is a part of the market approach. Now, if you talk about valuation, there are 3 common approaches which are used. One is the income approach, the other is the market approach, and the third is the cost approach. Now, income is already DCF. It was already existing and it still exists. The market approach is brought on under this new 5 new methods which are applicable only for non-residents, and cost approach is also brought in, which we'll see in the next method. So this is the market approach, and here under the market approach there are various methods. So approach is a broader way of looking at it, and methods are specific techniques and ways of valuation. So within the market approach, there are various methods. Two very common methods are comparable company multiple method, and the other is comparable transaction multiple method. I'll come to the difference in a bit. But the comparable company method is where you are taking the metrics of similar businesses and adjusting it for your business and applying it to arrive at the valuation. So if let's take 2 comparable companies. One is say TCS and one is Infosys. Both are IT sector companies in the IT sector. If for the purpose of the example, if TCS is has a multiple of say 10, there are various multiples can be used, but say the EV by EBITDA multiple is 10. So in that case, can that multiple of 10 be applied for Infosys as well? The answer is yes, but we have to make various adjustments. Now, this is where valuation comes in. As a valuer, you have to have a professional judgment as to what are the adjustments to be made. Very common adjustments are one is very common is the capital structure. So if company A is funded only by equity versus company B, which is funded by equity and debt, we make an adjustment because the risk profiles are very different. Company with more debt is has a higher risk profile than a company with less debt. So all these adjustments have to be made when you are arriving at the comparable company, when you're arriving at the right multiple to be used under this method. Very common is the EV by EBITDA method, where you are looking at the enterprise value upon the earnings before interest, taxes, depreciation, and amortization. So a question was, question was raised that under these 5 new methods which have been written, only comparable company multiple method is prescribed. So what about comparable transaction multiple method? Like, was it intentional on the part of the government to exclude that, or was it that they had to tell about the method under the market approach? The rational answer is obviously that be conservative, and if we have written only comparable company multiple method, use only that. We cannot use comparable transaction multiple method. Now, the only difference between comparable company and comparable transaction method, CCM and CTM, is that in CTM, we are not looking at a company as a whole. We are looking at a transaction. So, suppose a social media company has been, last week itself, it has been valued at, say, rupees 100 a user, and there was a merger or a M&A transaction or some investment. So it was valued at 100 rupees per user. So if I am a social media company in a similar metric, So under the CTM, which is the comparable transaction multiple method, I can say that even my company should be valued at say 100 rupees per user and adjust it for any specific differences. The core concept is the same in both CCM and the CTM methods. The core concept is exactly the same. However, one seems to be excluded in this Rule 11 UA and one is not included. However, that is the it is what it is. Second is replacement cost method. Now, replacement cost method is a part of the cost approach. Again, as I discussed, this was already existing in market. Everyone uses the cost approach as well. Like all the three approaches are very commonly used. However, till last month, only the approach of DCF was allowed under income tax. Now, this two new approaches have been added. However, they are only for raising money from foreign investors. There is no seeming logic as to why resident investors should not be covered. But currently it is applicable only for foreign investors. Now again, under replacement cost, it's very well known when you are arriving at a asset's value by seeing it, arriving at the value of the asset by seeing how much it would be worth today. You find the replacement cost of the asset and you ensure that it is at an arm's length transaction. That is how the replacement cost is found out. Again, it's very common. ICI valuation standards, international valuation standards, all different. Canadian valuation authority, their international standard, their valuation standards cover this as well. So it's a very commonly used method. And again, when you are looking at the replacement cost method, you have to factor in key adjustments like obsolescence and advancement in technology, geopolitical risks, etc. Third is the probability weighted expected return method. This is I would say a surprise as a valuer. It's a surprise to have seen this method being included in startup. When we talk about valuation of startups, this method, very similar method, is the first Chicago method, which is very similar to this method. However, if you look at this method, the name itself is very self-explanatory here. What it is probability weighted and expected return. So these are the three terms which will explain how this method is to be done. One is probability, the other is weighted, and the other is expected return. So what we have to do in this method is find out the expected return or the expected valuation under various scenarios. Now it can be very simple to have maybe say three scenarios only. Which is normally the case, best case scenario, worst case scenario, and normal base scenario. That is one option. Or you could go more complicated. You could say there are 5 scenarios. What if X party comes into power in the next year's election? Then we can have, we can create as many scenarios as you want to based on the, differences in each scenario. So when we talk about the expected return, we look at the expected return or rather the valuation under each scenario. Then we do a probability weighted. So we apply weights to each scenario and we see what is the probability of each one occurring. And then we multiply it and get the mean answer, which will be the valuation under this method. Again, this is not very commonly used in India. Very rarely it is seen that we are using this method. And I'll come to it why it's not being used. So again, it's a multi-step process in which the value is estimated based on the probability weighted present value of various future outcomes. So we do step 1 is to, as I said, conduct a valuation for each future possible outcome, then attach weights to each outcome based on the probability of its occurrence, and discount it back to the valuation date. Now here is the reason why it's not very commonly used and what is the issue with this. Now valuation in its essence is we call it as a GIGO approach, garbage in, garbage out. So the sense is that whatever you put in by way of assumptions, numbers, facts, figures will be reflected in the output. So there's garbage in, garbage will be out. So there is already a lot of subjectivity and skill and judgment involved in a normal valuation too. However, when we are uh, carrying out a valuation for each possible outcome, you see, in this we are carrying out valuation for each scenario. So when we are carrying out valuation for each possible outcome, we are increasing the scenario, we are increasing the subjectivity involved, we are increasing the garbage in by 3x. If there are three scenarios, we are increasing it by 3x. So that is obviously, one of the biggest concerns when using this method, is that it increases the, already there is a lot of subjectivity where, but you're doing it thrice, you're doing a valuation thrice. So all the assumptions, you're if you're using the DCF, you're using you're assuming that the cash flows for the next 5 years will be an X amount under one scenario, then you will be adjusting it in another scenario, and so on. So this leads to a massive increase in subjectivity. So that is another reason. Again, each of these options is at the option of the assessee. The assessee has the choice whether to opt for either of them. The the fourth one is the option pricing. Now, this is a pleasant surprise because this is something which is taught only in our valuation courses in detail. Hardly it's been taught to outside the valuation courses, and it's good to see this option pricing method has also made its way into our income tax law. So basic concept is that if there is any class of shares which have any option attached to them, mostly like say preference shares or compulsory convertible preference shares, or even equity shares which have an option of being upgraded to a higher class, we can value the option with class. We can value it as a call option. For that, we can use various methods. There's binomial option pricing, Monte Carlo. There's most commonly used the Black and Scholes, option pricing model. So yes, obviously, to discuss that entire thing in detail will require another session. Fully, it will require more than a session, to be honest. Those option pricing methods are, what we have to do is basically we use log normal distributions, and we plot the past performances to anticipate the future outcome. So one of the the criticisms, or I would say the limitations of this method, is that we are assuming that future outcomes will be determined by plotting a past performance on a graph and using log normal distribution to arrive at the value. So while it's I wouldn't say it's difficult. Option pricing is not difficult. It's just a bit complicated. It's not difficult. Once you understand it, it's pretty easy. But it's not that easy to. It's not that straightforward. And that is again a reason why a merchant banker's report has been asked for in this when you're applying for this. Another is a milestone analysis method. Again, this is a very surprising method to be included. Globally also, if you look at the method, in fact, just Google this milestone analysis method, and you'll see the content is very less. So this is not a very commonly used method. Similar to that probability weighted expected return method, this is not very commonly used, and even globally, the feedback received is that it's not very common. However, this has been brought in. No one knows where this has come from. But again, this to understand what this method means. The milestone analysis method, again, the name itself is explanatory, where we are looking at milestones. So again, this is relevant only for early stage startups, and the concept is that as and when a startup or a company achieves certain milestones, which are determined between investors and the company, as and when the company achieves those milestones, the risk profile of the company decreases. So say if a company gets a turnover of, very simplistic milestone, turnover of say 1 lakh rupees. If that is the first milestone, then the risk profile goes down, because now the investors have proof that the company idea or the company's project is actually taking off, and there is some tangible proof of that. So that is a milestone. There can be different milestones, for say a media company, there could be number of users, different milestones based on different industries. So yes, and under this method, yeah, it involves identifying specific milestones for a company. So every company will have its own milestones. You can't have the same milestones for each company. Best example is customer acquisition targets, revenue goals, and as each milestone is achieved, the company's risk profile decreases. As I said, this method is subjectivity is obviously involved. There's a lot of subjectivity involved in here. However, even globally, this method is not very common. If you do a normal Google search, you will get the links of understanding this, but they'll be far less in comparison to when you Google say a DCF method or these popular methods. With this, we move on to clause B of subrule 2, which is on CCPS. Not much to discuss, to be very honest. However, as I'd shown before, earlier, all types of preference shares, be it compulsorily convertible preference shares or optionally convertible preference shares, they would not be covered under 11 UA subrule 2. They would be covered under Rule 11 UA subrule 1 CC, where we have to look at the open market value of the product, of the shares. So that was the case earlier. But under this new revamped Rule 11 UA, what has happened is compulsorily convertible preference shares have been brought inside 11 UA 2. They have been, because they are very similar to equity shares, eventually they are going to be converted into equity shares, treated at par with equity shares. Earlier, yeah, they were covered under 11 UA 1. Now they are covered under 11 UA 2. The OCPS continues to be covered under 11 UA 1 CC. Yes, so the way of calculating the FMV is very similar. There's option given to the assessee to determine the FMV, either of the CCPS or to use the FMV of the equity shares, whichever is easier or beneficial to the assessee. So if you look at the 5 new methods, apart from the book value method, because obviously the book value is method is for equity shares only. But apart from the book value method, you can use any of these methods to calculate the FMV of the CCPS. Now we'll look at the other, subrule 3 as well as subrule 4 have been also inserted in the notification last month. One is on date of merchant bankers report. Now, this can be a bit tricky. While it's seemingly very straightforward and a very good provision, this can be, get a bit tricky. Earlier, what used to happen was, practically at least, since there was no clear guidance, it was assumed that the merchant bankers report should be as of the date of issue of the shares. So if the issue of shares is say on 29th of October, the merchant bankers report will also be around 29th of October only, not more than 2 or 3 days plus or minus maybe max. But that was what was practically being followed, and because there was no clear guidance. Now what has happened is, under the new 11 UA, they have introduced a subrule 3 where they have said that the valuation report by the merchant banker would be acceptable if it is issued up to 90 days before the date of issue of the subject shares. Now, again, this is on its face, it's a very good move which provides flexibility to the two companies. However, there is a small question which can arise here is, so let's see the timeline. So if you look at, there are 3 dates here. One is the date of valuation of the equity shares. The second is the date of report by the merchant banker saying that he's valuing, or he or she is valuing the shares as on the date of valuation. And the third is the date of actual issue of shares on which this entire 11 UA is being applied. So here there are 3 dates. Earlier, what was practically being followed is that they tried to keep all these 3 dates in a very close margin of each other. So even the date of report of merchant banker would be around the date of valuation, and the date of issue of shares would be immediately after the date of report by the merchant banker. So earlier, because there was no clear guidance, this used to be the case. Now, if you look at the language of the section, so let's look at the rule. So if you look at sub rule 3, which is this, it says where the date of valuation report by the merchant banker for the purposes of sub rule 2 is not more than 90 days prior to the date of issue of shares, which are the subject matter of valuation, such date may, at the option of the assessee, be deemed to be the valuation date itself. So here, what the sub rule is talking about is the date of valuation report by the merchant banker versus the date of issue of shares. So, in terms of a PPT, date of valuation report by the merchant banker versus the date of issue of shares. So, this is the plain reading of this. This is the plain reading of the sub rule. However, a question will arise: what about the date of valuation? When should the date of valuation be? So, if the date of report by merchant banker should, and the distance between these two is 90 days, less than 90 days, then what should be the distance between these two? Now, again, there are a lot of deliberations going on, and these are, however, the better view, in my opinion, is that all three of them should be within the 90 days thing. Because while you can't have, suppose you're today sitting on 20th of October, and you take, date of report, say, 31st of July, which is 90 days back from today. Suppose the report was issued on 31st of July, and the date of issue of shares is today. So the date of valuation should not be, say, 31st of March. The date of value, it should not be, just because it's not given does not mean we adopt a irrational stance. So the better view of the matter is that since the new sub rule has given a time limit of, say, 90 days, so the entire, all these three dates should be within the timeline of 90 days itself. The obviously industry bodies have written for clarification on this. I don't think any clarification has come as of now. And another interesting concept which has been introduced is under sub rule 4 of 11 UA 2 4, is 11 UA sub rule 4 is safe harbor. Now, under income tax, the concept of safe harbor would exist specifically for entities which are transfer pricing. So the concept of safe harbor is that it recognizes that valuation itself is not an exact science. Like two people can use a method and arrive at different values, and there is, because again it's GIGO, right? Garbage in, garbage out. So whatever inputs you give to the whatever inputs are being given to the whatever in the valuation exercise, it will reflect in your output. So if there is any difference of even a 1 rupee, it's the difference of 1 rupee, it can drastically change the entire valuation result as well. So the valuation is not an exact science. Similar was the concept in transfer pricing as well. It said that as per various methods, people can arrive at different values. So there was a safe, but now it has been introduced in valuation as well. And a very good move, and it shows that income tax is also recognizing that valuation is not an exact science. Now, what happens is there is a safe harbor limit of 10% for issue of these unquoted equity shares or CCPS. What this means is that if the price at which the shares are issued is higher than the value determined as per 11 UA, but the difference does not exceed 10%, the issue price will be taken as fair market value. So if your example as well, so if you are issuing a share, or rather a share at 1000 rupees, but the FMV comes to, say, 950 rupees or 910 rupees also, then angel tax provisions will not apply. This is a logical thing as well, because Earlier, there used to be cases, practically we have seen where you're getting a report from a CA or a merchant banker, is mostly from merchant banker under BCF, where if the issue price is say 985 rupees, you are getting a report from the merchant banker of a similar amount. So that again that does not seem very genuine, and that is obviously not the intention to valuation. It's very well known that valuation itself is not a exact science. It will differ according to people. In fact, the same person may, if he or she has to do the valuation twice, will arrive at a different value. I am mostly sure if that person has to do the same valuation twice, even just 10 minutes from each other, they will arrive at a different valuation because of the lots of assumptions, lots of inputs go in. So similarly, this concept has been brought in. Good thing is that this is not applicable when you are using benchmark pricing methods. So if you are using the benchmark pricing methods, the example I gave of say a VC saying your share is 100 rupees, you can't use the safe harbor limit there. The safe harbor limit has to be used, like it has to be at the share issue of shares to other investors. It has to be at that uh, benchmark price or below only. You can't say I have a safe harbor of 10% there. This is the this is the rule which has been there. So we have discussed the amendments which have come in Rule 11U. Now let us look at a few issues. Now we have discussed most of the issues. However, let's take a look at the few issues which arise post amendment. One is most recommendations to the public draft have been ignored. Again, this was there, very common. I would say I went through all the representations which have been made by industry bodies, professional bodies, and most common of the recommendations which were there is that one is to since you are revamping the rule, so might as well reduce the compliance cost for businesses by not having multiple reports for different laws. Now what happens is under FEMA, when you are getting FDI, you have to get a valuation report under FEMA as well. Now the Reserve Bank of India requires a valuation report there. Now there the option available is to get a report from a practicing chartered accountant or a merchant banker, registered valuer. There are rules under FEMA, separate rules under FEMA, and there are separate rules under income tax. Where either you have to get a report from a practicing chartered accountant or from a merchant banker. So here in this, most of the earlier cases used to be under DCF. As I said, it's the most common one. So there would be a merchant banker's report under income tax. However, there could be a report under FEMA which could be taken either from the merchant banker or from the practicing chartered accountant, because that is allowed under FEMA as well. So there was always a discrepancy as to do we need multiple reports for different laws, whereas a transaction is one and the same. It's a normal foreign investor is investing money in a startup under FDI route. So transaction is one and the same, but a business may have to obtain multiple reports under different laws and ensure that the reports are in consonance with each other. Then again, second recommendation was to include registered valuers. Now, again, merchant bankers, they are the primary business, I would say, of a merchant banker is not to do valuation. While merchant bankers do valuation and they have historically been doing valuation, but that's not their primary business. So instead, there was a recommendation to include registered valuers who are specifically studied and trained and regulated only for the purpose of valuation. However, that has again not been there. We'll see it's I think it's the Valuers Bill 2020 which is still pending, and maybe that's the reason they have not included that. And again, as we discussed, to make the 5 new methods applicable for resident investors as well. Because this should have been, this was a very logical demand, I would say, to make the 5 new methods applicable for even the resident investors, considering even if not all the 5, but at least the market approach as well as the cost approach, they could be applicable considering they are very commonly used nowadays. Yeah, date of merchant bankers report is not the date of valuation. We discussed that. Then date of applicability of the revamped rule. Now, if you look at the sub-rule 2, so if you look at sub-rule 2, you see it has been implemented with effect from 26th of September 2023. Now, the amendment in section 56 to 7B, where they have removed these words being a resident, it is applicable from assessment year 24-25, which effectively means previous year 23-24, which means 1st of April 2023. But the amendment, this amended rule is applicable from 25th of September 2023. That is the date it was notified as well in the official gazette. So what about any issue of shares which has taken place between 1st of April 2023 and 24th of September 2023? In that case, will the old rule continue to apply? The intention does not seem to be that. However, based on a reading of the notifications as well as the new rule, it seems that there is this discrepancy which a clarification would be clarification can be achieved. However, since this is not the clearly not the intention of the law, the intention is the time non-residents get covered, we can the revamped rule 11 US of rule 2 should be applicable as well. And this is next we want to impact on startups. Now, when we look at startups, while it's a very loosely used word, everyone calls themselves a startup. But for the purpose of, I would say, income tax, where it has been specified. Now, section let's see, talks about angel tax and it provides an exception. And this exception, it says that the include companies which are notified by the central government in this behalf. So when they talk about excluding certain persons, there are notifications. One is, and for startups as well, registered startups with GPIT, there has been a notification on 19th of February 2019. This notification is not by CBDT. Notification is by the Ministry of Commerce and Industry for DPIIT, which is Department of Promotion of Industry and Economic Trade. The DPIIT notification and the central government itself is notifying that certain startups will be covered. Now, if you look at this notification, there is a specifically talks about exemption from 56 to 7. There is clearly written exemption for the purpose of clause 7 of the Act. So a startup shall be eligible for notification of clause 2, which is the clause to the proviso, which we just saw, and consequent exemption from the provisions of that clause if it fulfills the following conditions. Now again, this is the original notification that has been amended subsequently. So this is the original notification, and it says there are two conditions. One is it has recognized by para 2, 3, or it the aggregate paid up share capital share. If you look at how does it get recognized by DPIIT? Para 238. So for DPIIT, there are a list of requirements for the purpose of recognition. Again, it's very simple. I would not say simple, but it's relatively easy after getting an exemption for 56. Is firstly it has to be recognized as a startup. So you have to go online to the startup website and Startup India website, and there you have to apply for exemption. So there the startup has to write about how it is working around innovation development or generating wealth or employment. So it has to be the right and but it's relatively easier to get this around in India. Around I think lakh or so startups are really registered with DPI. And there are other conditions as well. That it has not invested for the purpose of getting has to fulfill other conditions. And these are that it has not invested in. So, while we go through each of the condition, but the basic concept is that a startup should not be using like investing in things which are not for the purpose of its business, unless that is the normal course of it. Let's say a startup should not be purchasing cars for their that startup should not be purchasing cars for their employees or for their personal use. They should not be purchasing houses for their employees for personal use only. So that is these are the few conditions unless that is in the ordinary course. One is quickly let's see. One is being a residential house, then land which is occupied by unless it is occupied for the business, then loans and advances, any capital contribution to another entity, shares and securities, motor vehicle, aircraft, yacht, and which exceeds 10 lakh rupees, other than which is used by in the normal business, jewelry, and etc. etc. So these are the exceptions that a startup should not invest money. The entire concept is there that a person should not be investing money of the startup for purchasing personal assets. That is the entire thing. And again, there are few conditions given here. If these conditions are fulfilled, startup becomes eligible for exemption. Startup becomes eligible to be notified for the purpose of exemption from 56 to 7. So the question arises is, with the new revamped rule in India, is there any change for startups? The answer to that is no, because most again it was originally not applicable for startups registered with DPIIT and notified, and it will continue to be exempt under even the revamped section 56 to 7B and read with rule 11 UA. So with this, we move on to I would say the last part of our discussion. I have a few highlighting points I want to discuss here, and we talk about the professional opportunities which arise for chartered accountants and valuation professionals. One is there is a Valuers Bill 2020 which is still pending. It has not been cleared by the houses of the parliament. And in that, what it says is if the essence of that bill is that once the bill is passed, all the valuations done in India would be done by valuers only. There would be a separate IOV, Institute of Valuers, which will be established, and the IOV will be responsible for regulating. It will be as like an autonomous body, just like say our institute. There will be another Institute of Valuers who will be taking control of all the valuations to be done, which is in line with the model followed across globally. Globally as well, this is the case. There is a separate Institute of Valuers in most developed economies. So values bill is pending. So as we discussed, there's a lot of debate over why merchant bankers are considered and not chartered accountants or registered valuers. So currently, if you see the valuation of equity shares, we have seen all the valuation new methodologies as well under Rule 11 UA. Even there, wherever DCF is there, merchant banker is required. Even under the 5 new methods, a merchant banker is required. So the question is whether a practicing CA is required or not. So this is just my practical experience which I'm going to share. Is clients prefer to obtain a CA certificate or CA report, or when they are talking about valuation, because merchant bankers, while they do valuation, they are definitely wherever they are required to do valuation, it is required, say DCF or those 5 new methods. Where it is required, it is required. You can't, there's no skirting the law. But where it is not required, like in case of the, can say the benchmarking or even the book value method, there are a few nitty-gritties involved in each of them, right? So in those cases, there are a lot of professional opportunities for chartered accountants where I have seen clients approaching us for getting these valuations done, even though they are not required to. By law, they are not required to, but as a good practice, as a purpose of understanding, purpose of understanding where or like how to substantiate it to the assessing officer if it is asked in the future, or even for their internal purpose is to keep it on record. They tend to approach chartered accountants before merchant bankers for the simple reason that chartered accountants are more qualified to and more focused on this. So, especially for valuation of equity shares, as well as even for CCPS, as we saw earlier, there was the option that for CCPS under 11 UA1 subrule 1 EC, there was the option given to the assessee to take a report from the merchant banker or the chartered account, practicing chartered account. But with the new sub rule, it has gone under rule sub rule. It has gone under sub rule 2 for CCPS. So for CCPS, a chartered accountant cannot anymore certify. But for OCPS, again, it still remains under 11 UA1 CC. And as I said, my practical experience is that unless it is regulatorily required or legally required, companies prefer to take the expertise or take a report or a certification from a practicing CA. For that itself, it's very important to always understand the complexities. So all the complexities that we discuss, companies will approach us to get the value, especially in case of benchmarking. There are nitty-gritties involved there. Just the biggest one is the date of in the benchmarking, the date of issue of shares versus the date of receipt of consideration. So we have to look at the date of receipt of consideration for the benchmark for the notified entity or the VC versus we have to look at the date of issue of shares for the other investor. So these are all complexities which where the role of chartered accountant can never be I would say discounted. And so this is I would say under the new rule also there are a few complexities which are arising, and as chartered accountants it is our role to understand it, comment on it, give a commentary as well, have a viewpoint on it, and when clients approach, we should be in a position to give a view on it, rather than having that mindset that it's all with the merchant bankers. That is not true. A lot of things which are not with the merchant bankers, for those companies will approach us only. So with that, I think I'll wrap up. I think we are on time. So I'll again this entire amendment, and the moment they have section 56 to 7B was amended under the Finance Act, we were there was a lot of hue and cry in the market. I recall reading every day in the Economic Times there used to be some article on this. What could be the negative implications of bringing non-residents into angel tax provisions, and given the past track record, I would say it's a very good move that the government has been very proactive. Firstly, in releasing the draft notifications, they have released the notifications and asked for public comments. That they had done in May 2023 itself, and then they have I would say before even 6 months have passed from the applicability of this, they have come out with good rules. They have come out with the final rules as well. Again, this is a proactive approach. It demonstrates a good proactive approach by the government. Shows that the government is concerned, that FDI or foreign investment should not dry up because of these uncertainties, which is fair because in my experience as well, foreign investors, they are not as much concerned about the quantum of tax as much as they are concerned with certainty. They're more concerned that if they take a position today, what is the likelihood of it getting challenged in court tomorrow? So that is their main concern. And by bringing out these rules, the government has shown a good proactive approach, and it's timely as well, I would say. And definitely it helps the investment environment. So whenever I speak about any issues in law, this is something I always stand by and just close it with, is saying that having certainty on an adverse law is much better than having a good law, but there are loopholes and uncertainties left. Because that is what investors and taxpayers value. Even if you have a adverse law, at least if there is some certainty, it is appreciated much more than any law which has a lot of loopholes and discussion points standing. So with this, I'd like to conclude. I think we are on time as well. Please feel free to ask any questions. I'll be taking questions. In case you're not able to, you can connect offline as well. My coordinates are on the screen. Inderjeet, are you there?
Thank you so much, sir, for the valuable session you have delivered. So we have some questions. So I would like to read for you.
Sure, please.
So first question, can we do valuation under section 11 UA based on audited financial statement, since some of the clients insist for transfer of shares during the year, say 30th September?
So unaudited, whether we can use unaudited or not is again at the as per the valuation date. So valuation date is defined under Rule 11U of the I think sub Rule J. It defines valuation date. Now, if suppose the shares are being transferred today, which is 29th of October, and you are required to obtain a valuation report. If the valuation report is from the merchant banker, then the merchant banker has to do the valuation. They have to take unaudited financial statements. In practically in most cases, unaudited financial statements are taken. However, as a valuer, you have to exercise professional judgment to ensure that at least the basic sanctity of the financial statement is maintained. In our experience, a lot of times, when clients give us unaudited financial statements, they don't provide depreciation, they don't provide, a lot of normal adjustments are not provided. So as a valuer, while you may use unaudited financial statements, but ensure that, the basic principles of accounting are being followed.
Thank you, sir. So another question, in case of private limited company, can right issue be done at face value without attracting section 56?
So rights, again, this is a very litigious thing with a lot of case laws are case laws are active in the tribunal and the high court here. Whether section 56(2)(b) whether section 56(2)(7)(b) applies for rights issue of a share or not is again a matter under debate. The better view of the matter is that it does not apply. However, there are adverse judgments. I think in Karnataka there are a few adverse judgments as well. However, it's sub judice, so too early to comment.
Okay, sir. Okay. Another question, whether a practicing CA can issue report of valuation of equity shares in a private limited company for the purpose of transfer of shares in financial year 2023 to 24 on the basis of financial statement of the company as on 31st March 2023, or the company has to take it from merchant bankers?
So as we discussed, there is only under there is no specific section where specific rule under 11 UA where it's required for only a CA certificate will work. Either there will be a CA certificate or a merchant banker certificate, or there will be no certificate required. So, as a chartered accountant, if the companies, as I said, mostly companies want to have something on record, either for the or for future scrutiny assessment. They want something on record. So for that, they can approach you for say doing getting a valuation on any method where merchant banker's report is not required, or say the benchmarking method, where again a merchant banker's report is not required. But to keep it on record, they may approach you. But as per the law, there is no specific section where only a practicing chartered accountant can issue a valuation report. You're on mute, Indrajit.
Okay. Thank you, sir. Next question on the valuation of equity shares of a closely held company. Can we opt for a DCF method or we obtain a certificate from a merchant banker?
So if you do valuation, so if you want to opt for DCF method, which is under subclause B of the sub rule 2 of 11 UA, if you want to opt for DCF method, you have to mandatorily approach a merchant banker for that. There is no other alternative, sadly. And even if the practically the calculations are done by the CA of the company, but the report has to be obtained from the merchant bank.
I hope the question has well answered. So, next question: is there any provision on how to how to report significant events between the date of merchant banker report and date of valuation?
So the date of merchant, I presume the answer is between the date of merchant banker report and the date of issue of shares. So the date of valuation will always be either on the date of the merchant banker's report or on before that. So assuming the question is for between the date of merchant banker's report and the date of issue of shares, if there are any significant events, the right approach, or which is also practically followed, is to take a fresh report. Because if there are any significant events, it should definitely factored into it. Again, if there are any significant events after the valuation date, they should already be captured in the merchant banker's report. If there are any significant events after the merchant banker's report, it's better to take a fresh report which captures in the significant events, because these are very common questions asked during scrutiny assessment proceedings.
We have one question on the listed or unlisted company. The company which was previously listed and during the year it got unlisted on account of acquisition through NCLT order, and all listed share cancelled and acquired company issue new share as a part of purchase consideration. Is Rule 11 UA applicable?
So 11 UA whether the company is listed or unlisted has to be seen under different laws, under different sections at different points of time. For Rule 11 UA, the date of whether the company is listed or not has to be seen whether as on the date when the shares are transferred. So if the date of as on the date of issue of shares, if the company is unlisted, then at that time, section 5067B will trigger.
Thank you, sir, for answering these questions. We have one more question left with us. There is a school of thought that section 56 subsection 2x as also applies to issue of equity shares by unlisted companies, but when section 56 subsection 2 8b specifically made applicable for the share issue situations, which taxes any excess over fair value determined thereunder. So, how can tax be levied under section 56 to 10 when I follow the rules laid down by the 56 to 7b? Please advise.
So again, principle of interpretation of that gender specific overrides gender. So 56 to 10 is it uses the word security. Security is very wide, it includes for sure. But if section 57B applies specifically talks about share. And if you go into Rule 11, it talks specifically equity shares and preference shares. So by using the principle of legal interpretation that specific overrides general, 56 to 7B will be applicable. Again, using the principle of that double jeopardy cannot be levied on a particular transaction, then both 56 to 7B as well as 56 to 10 cannot be made applicable at once.
So we have few more questions. Can I ask,
Yeah,
sir,
sure. We can take,
with
actually,
your
we can take till the time, and if there's any excess questions left, we can connect offline as well.
Okay. So I think I could take one last question. Is startup exemption to section 52 subsection 267B available for any startup registered with DPIT having known resident shareholders of startup?
So DPIT, the exemption is available once the startup gets notified. Now, to get notified, you have to fulfill the conditions under, I think we briefly went over the conditions which were mentioned, and the startup has to fulfill those conditions as well as make an application on the Startup India online website. Go and make an application. There are two stages here. One is where you are applying to be recognized by DPIT as a startup. First phase, as I said, is pretty easy. I think around 1 lakh startups are already recognized by DPIT. The second stage is when you get registered for the purpose of claiming exemption under from angel tax, as well as for Section 80 IAC, tax holiday. So that is the second stage, which is a bit more difficult. Per my last reading, I think around 5,000 or 6,000 startups have been at that stage only. So yeah, it's not automatic. There has to be an application which has to be done with the DPIIT on the online website.
So thank you so much, sir, for answering these questions.
If there are
And
any other questions, I'll be happy to take them offline as well. So you
offline,
can
yes.
reach out to me.
Okay. So as sir said, all the participants, you can ask your questions offline. And I would like to thank our distinguished speaker for their valuable insights. And before concluding, I would like to make an announcement for those participants who were asking about where they can see the previous sessions of the Valuation Manthan. So you can search Valuation Manthan sessions on ICA YouTube channel, that is ICA CA Tube, and no unstructured CPA hours will be allowed for watching previous sessions on YouTube. But two unstructured CPA hours are eligible only for live sessions on each Sunday, like we are live today. And I would like to ask my participants to please fill their feedback form as appearing on your webcast screen. So thank you so much. And so I would like to extend my sincere thanks again to our distinguished speaker, CA Vijay Kumar Puri ji, for their extraordinary knowledge sharing on the topic. And I would like to express our gratitude to our chairman, CA Hansraj Chugji, and vice chairman, CA Preeti Parasalva ma'am, for initiating this platform for the field of valuation and guiding us. And we would also like to take a moment to acknowledge and appreciate our participants for dedicating their valuable time even on a holiday Sunday. And seriously, your enthusiastic response and the questions you asked has been a tremendous source of motivation for us to continue our journey of knowledge sharing. So, thank you everyone for your active participation. So, we eagerly anticipate meeting you again in our upcoming sessions. Until then, have a wonderful day ahead. Thank you.